First of all, welcome to our first quarterly market evaluation. I'm Bruce Moss, and together with Mark, we're going to go through how we see the investment markets, or the changes rather that have happened over the last quarter, and how we see them for the future. The purpose of these webinars and our quarterly market evaluation is basically to provide advisors and other users of our financial planning tools, stochastic modeling and asset allocations with information about how our model sees the outlook for the markets. We produce optimized asset allocations and portfolios for a number of clients, and we've done this for many years. What we're going to do this morning is not really talk so much about those, because those optimized asset allocations typically have constraints. The sort of constraints they have are a home country bias. In other words, more invested in the UK than would be justified necessarily on the grounds of investment. Also, some constraints are sort of, we limit the amount that, for example, one might have in emerging markets. So these sort of constraints are very typical in portfolios. But what we're going to talk about now is really what the underlying model is telling us about the investment markets. And basically that's what we're going to do. So I'm going to give a brief introduction. Mark is going to take us through the market commentary, and basically as we go through this, you'll have the opportunity, if you want to and please do, ask questions. There's a little question box on the side of the screen, on the right-hand side of the screen. And if you put your questions into those, we can pick them up at the end of the webinar. So we're basically going to go for about 20 minutes, and hopefully with 10 for questions. So what we've been doing stochastic modeling. We use what we call an economic scenario generator, or ESG. We've been doing this since 1993, and we're actually doing it, I think, longer than anybody else in the world. We started doing this for investors way back then, and have obviously considerable experience of doing this. In our economic scenario generator, what we do is we sort of stick to medium long-term perspective. So we're not really looking at the sort of short-term tactical asset allocations. That's not really where our focus is. What we're trying to do is to look at sort of the longer term with a view to getting sensible asset allocations and giving sensible forecasts of how the outlook may be in that medium to long term. Basically, the key requirements of our economic scenario generator are basically to make sure that it changes with economic conditions. It's seeking to plot a journey into the future, so clearly it has to be sensitive to changes in economic conditions. It's a global model, so we have to make sure that it's consistent around the world and models all markets in a similar way, so that you see the effects of changes, let's say in the US, how that impacts on other markets. We model inflation. That's absolutely core to the model. Clearly, as it's a global model, exchange rates, and then having an exchange rate model is very important. We also model income and capital growth separately. So again, we can that's very useful for the purposes of taking account of tax, those impacts. And finally, because it's a real model reflecting real market conditions, basically the returns depend upon how long you're investing for. So it's term dependent, so the outlook will vary over the time horizon that you're looking at. So that's a very key part of our model. Because it's trying to give a realistic picture of the future, we have to make regular updates to it, and we have a continuing program of investment. In fact, over the last 4 years, we've invested over £1 million in our model. So we're trying to provide the best model possible in changing economic conditions. This is an overview of our model. It's a very simplistic overview, because we model up to about 60 different returns and asset classes. So this is a very high-level view of our model. As you can see, because it's an economic scenario generator, we have on the left-hand side of the screen effectively an economic model. It starts with a yield curve for nominal and real interest rates, and from that we estimate inflation, and that gives us on the right hand side the outlook for inflation-linked bonds. The nominal rates also help us obviously model cash and government bonds. And from the nominal interest rates we deduce sort of equity. The model deduces equity dividend yields and dividend growth rates, and that in turn helps us to model equities. And from cash and government bonds and equities we estimate corporate bonds, because there are characteristics of corporate bonds that both reflect, if you like, government bonds, fixed interest bonds, and also the companies that issue them. Clearly that gives us a sort of certain amount of equity content. So a corporate bond is estimated from those two separate models. We look at property, obviously again looking at sort of rental yields and growth rates, again coming from nominal interest rates, and also currency strength. So the model essentially starts with an economic model on the left and moves over from that economic model to estimate investment markets. So finally, my little bit, we just want to talk about the simulated returns. So from our model, what we do is we are describing the evolution of the market, how it's going to start from current conditions and how it's going to go into the future. Now, we produce lots of simulations of that, thousands of simulations to illustrate how the market may develop from its current situation. Because it basically is effectively a journey, we have to reflect the current market conditions, so that's the reason why we have quarterly updates in our model. It's a bit of jargon here, it's a state space approach. What does that mean? Well, it means that the probability of things happening depends upon where you start, and the best way to sort of illustrate that is to talk about the current situation. The current situation, we have interest rates close to historic lows. The probability of them falling further is obviously not great. Whereas the probability of them rising is much greater. If interest rates were currently at 10%, the probabilities would be very different. So the probability of things happening depends upon where you start. And finally, the last part of maintaining and looking after our model is to do regular model calibrations. We do these once a year, normally in the summer. And essentially what we're looking at is effectively the factors that go into the model. We have another year's worth of data, and we're always refining the model to keep it as realistic and as good as possible. So at that stage I'll hand over to Mark, who will take you through the investment markets.
Okay, thank you Bruce for that. What I'll do is I'll walk through the changes in investment markets over the Q1 of 2015. And illustrate how those impact the asset model and the results that come out of the asset model in terms of the expected returns and the volatilities of different asset classes. As Bruce said, we start from modelling a government bond yield curve, and it's a state space model, meaning that it evolves from the current market conditions. And it evolves in future from those market conditions that it evolves into. So after the first year in the forecast going forward, if in that forecast yields have gone up to 5%, say, then the model will evolve forward from there. And that's what we mean by state space forecast. But what's important then in the initial conditions is the government bond yield curve that goes into that initial calibration. So what happened to UK government bonds over the first quarter? The graph I've got up here is the 10-year UK government bond, which started at just below 1.5%. The first month saw some fairly significant declines in the yield, so it dropped nearly down to 1%. March saw it peak back up again to over where it was at the beginning of the year, and then the third month of the quarter saw it fall back to basically end the quarter pretty much where it started. A little bit lower, but after a pretty significant ride during the quarter, both up and down, it ends up at the end of the quarter just a little bit lower. Now compare this to yields around the world. The US followed much similar pattern, but with a very slightly higher expected return on the dividend or on the growth redemption yield than the UK. So they followed a very similar pattern. Japan has been bumping along at pretty much zero interest rates for at least the last 20 odd years now, and very little change there. However, in the Eurozone there was a different story. So Germany whilst it was already yielding pretty low at 10 years, ended the quarter below Japanese interest rates. Probably pretty much uniquely in the history of interest rates. So German interest rates at 10 years have now fallen below Japan, and indeed show some signs that they could even be potentially zero or even possibly negative. France followed a very similar pattern and ends the quarter very marginally ahead of Japan, but possibly two striking ones is Italy and Spain, which even a couple of years ago would have been quite high yielding bond returns in those economies, reflecting some of the structural problems in those economies. Now, what you're seeing with those major European ones is the impact of some quite aggressive quantitative easing in reducing the interest rates across the Eurozone. Finally, just to put it in context, if we overlay Greece on the same scale, you can't see any variation in the rates at all for the rest of them. So Greek interest rates at 10 years are still at least 4 times anybody else's. If you look at Greek interest rates, and indeed they're in the news this morning talking about potential haircuts on the bondholders and whether they're going to meet their repayments or not. Certainly in the short term, the yields are over 2 years. I think the yields are above 25% now. Looking at the UK interest rate again, and looking at the real bond yields, what you've got here is the 50-year government bond yield, which follows the same pattern as the nominal yield. So it fell in the first month of the quarter, rose over the second month, fell again in the third, to end the quarter actually in this case down from where it started. Now this is really quite significant. This is a 50-year government bond. And what we're saying on this one is that if you went into the market and bought a guaranteed 50-year return, you could guarantee to lock in 1% below inflation. Now, given that these bond yields drive a lot of the other asset classes, and there's systematically connected risk premiums to these, what this is explaining and what this is showing is the market expectations for low real returns on asset classes over the longer term. Then looking at equity markets over the quarter, the UK equity market gave a good return over the quarter, ended up 5% above where it started. The US, modest growth over the quarter, but certainly nothing spectacular. But the standout one over the quarter was the Eurozone, but producing a return over the quarter of nearly 20%. Now this ties in with the reduction in yields that we saw previously in quantitative easing. So quantitative easing is intended to make money cheap, pushes down the yields. Yields go down, investors go, where can I get investment return from? And what you see is potentially a systematic, well, if I can't get any returns on bonds, what do I buy? Well, I have to buy equities. And within the Eurozone, you saw a very strong return over that period. Japan produced good returns over the quarter. Emerging markets, I think, were probably best described as disappointing. And Asia Pacific ex-Japan were somewhere in between. The other standout element or thing that happened over the quarter was the strength of the US dollar. Now, what I've got on this chart is the US dollar exchange rate. And if you imagine that basically $1 US is a flat line along the bottom, then these graphs are what $1 US will buy in other currencies. So over the period, on a trade-weighted average, so the average of the rest of the world, $1 US at the end of the quarter will buy 8% more than it would have done at the beginning of the quarter. Looking at how that breaks down into individual currencies, compared to sterling, $1 would have bought 5% more in sterling, in pounds, but it would have bought 12% more in euros. So whilst you had a very strong euro currency return on the equities, and indeed you would have had a strong euro bond return. If you're a US dollar investor looking in at this, the decline in the euro currency strength compared to the US dollar would have meant that you saw much more modest returns. So looking at those same equity returns, but in a US dollar denominated basis, the UK was pretty much flat over the quarter. The US is the same as it was previously because there's no adjustment for the exchange rate. The Eurozone, whilst it was showing strong positive returns in euros, in US dollar only shows 5% return over the period. And again, this is logically what you'd expect with quantitative easing. So quantitative easing makes money cheap, pushes down interest rates, your equity returns go high, but your currency suffers as a result of it. And also that makes the economy more competitive in terms of exports. So that's what you're seeing there. Japan had a good quarter in terms of the returns, both local currency and in US dollars. Then moving on to what we've termed the eValue Equity Attractiveness Index. Now, what is this? Well, within the model we have a long-term equity risk premium, which is based or benchmarked on the UK market and benchmarked on a long observed history of the equity risk premiums. And from that we move that out into a coherent and consistent equity risk premium across all of the other major markets. So we have that long-term expected equity risk premium for these major global markets. Now, what we've looked at the beginning of the quarter is what the 5-year expected returns on these various markets are compared to that long-term equity risk premium. When I say equity risk premium, what we mean by that is the expected return of the equity market over a risk-free interest rate. So it's the excess return you're expected to get for the risk that you take on investing in equities. So we've looked at those at the beginning of the quarter, and at the beginning of the quarter we benchmark all of these at 100%. And then we look at how this has changed over the quarter and compare that to the beginning of the quarter. So what this shows is how things have changed between January and April. Now, what we're saying on that is that the US and Japan look much the same at the end of the quarter in terms of attractiveness as they did at the beginning. But the two standout changes over the quarter are Europe and emerging markets. Now, there's two different stories going on there. On emerging markets, you saw that over the quarter the performance was not spectacular. It pretty much ended up where it started off. But what you've got in terms of the relative changes of the attractiveness of that is change in expectation for future earnings growth. And we benchmark and we use market expectations of future earnings growth to look at where the markets are currently. So what you've got is emerging markets looking much less attractive at the end of the quarter because of that change in earnings growth. Europe, on the other hand, is a slightly different story. Go back to the earlier slides. Europe produced 20% return over the quarter, but with pretty limited change in expected equity earnings. So basically what you've got is you've banked 20% of your expected future returns, which is why Europe looks much less attractive in these terms at the end of the quarter than it did at the beginning of the quarter. Now, all of these are long-term expectations, and they're certainly not. Our model is not saying that any market is likely to move over the next quarter relative to other markets, but these explain kind of the direction of travel, and also when you look at optimization within portfolios or within our portfolio analyzer, why some markets would be favoured over the longer term compared to others. And the final couple of illustrations of how things have changed over the quarter is these tilt charts looking at the high-level equity and bond classes that we've got. So just a quick explanation of what these mean. So if nothing, these are risk-adjusted returns and the changes in their risk-adjusted return over the quarter. So if nothing had changed, you'd end up with a dot in the middle of this cross here for all of the asset classes. So if nothing had changed, you wouldn't show any arrows on this. But because we're looking at change in risk-adjusted return, the arrows show the direction of travel of those. So if you look at cash, you've got fairly modest reduction in the expected return, but fairly significant compared to other asset classes reduction in the expected risk of cash. Compare that to emerging market equities, where on an 8-year term, you're looking at a fairly significant reduction in the expected return, reflecting, going back to the previous slide, the expectations of earnings there, and actually a marginal increase in the risk as well. So if you looked at this compared to our optimized asset allocations, what you would be expecting on the shorter term here is perhaps favouring towards cash at the expense of emerging markets, and the other asset classes distributed in between. It's a slightly different message if you extend the term. So on here, emerging markets at a longer term look much less unfavourable than they do on a shorter term. And this reflects some of the term dependency that Bruce referred to earlier of our asset model. And the fact that actually within the emerging market equity element, you've got a reward for the additional risk that you're taking, but that comes through over the longer term. Even over the longer term, you're still showing the same kind of pattern of cash being more favoured on a risk-adjusted basis between January and April. And then finally, for those people like myself who like numbers, this is actually what it means in terms of the various asset classes at a high level that we model, with the change in expected return between January and April, and the volatility. Now these are 10-year, so the expected returns are 10-year compound annualized returns. So this is basically the return that you would get on your portfolio if you invest £100 at the beginning of 10 years. This is the expected return on that £100 averaged over the 10 years. The volatility is the average of each year's annual volatility within that 10-year period. So that would be the familiar volatility number of 20% quoted for equities. And what we show is the expected returns, as we discussed, on all asset classes are reduced over the period, and volatilities vary, as we discussed previously. Now, what you're showing on that is that if on the equity returns, between 4.5% and 5.5% as the expected return. Now, if you put these into a portfolio, you would expect slightly higher returns than that, because you have an element of diversification benefits coming through, an element of rebalancing benefits. But the overall conclusion is modest reduction in the returns over the quarter for the reasons that we discussed.
Thank you, Mark. Just to sum up where we are, then essentially what we're looking at over the last quarter is essentially a move away, if you like, from European equities, certainly favouring perhaps more Japan and US, and also an emphasis, a great increased emphasis on cash at the end of for the shorter term, for the lower risk investors and at the shorter term. So basically, that sort of, if you like, is the high level overview. A word of explanation here. This is not necessarily exactly what's going on in our asset allocations for two reasons. One is that there are constraints applied to those asset allocations to make them sort of acceptable to general investors. So there's a home country bias, which I referred to earlier. In addition to that, we've not been talking here about the benefits of diversification. So you might conclude from what Mark said that actually emerging markets wouldn't figure in any portfolio because they really don't, the outlook for them doesn't look very good, particularly in the sort of over the 5-year term, but even over longer terms they don't look terribly exciting. but they're still there because they offer diversification benefits. So when you look at our asset allocations, those will still be there. So what we try to do is give you an underlying view of what's going on within our model and how we see the future. Again, and just to re-emphasize, it's not a tactical decisions we're making. This is a sort of 5-year view as to how things may develop. But in terms of timing, that's not what we aim to do. What we're trying to do is give people sensible portfolios that for the medium to long term will ensure that they get a decent return on their money. So really just to sort of finally say thank you very much for attending this first of our webinars and investment market reviews. We will be doing them every quarter. After this you'll be getting some slides, and by the way, please give us lots of feedback because we want to make these really useful and helpful. Now I don't know, Ben, whether we have any questions, but perhaps we could now just sort of wrap up with a few questions.
Yeah, we've had a couple of questions come through. The first being around what impact, if any, the pensions freedom could have on these forecasts and returns.
So so as of April, the pension freedom obviously introduced lots more options for people taking their money at retirement, with some evidence that people are taking advantage of that in terms of accessing their money. Now, in terms of cash flows in the markets, this is likely to have very little impact because the actual size of the cash flows at this point in time compared to institutional cash flows which drive the market are likely to have very little impact in the short term. What's possibly more likely to have impact is the other way around, in that if you look at bond yields currently, the bond yields, as we talked about, are very low. Bond yields drive annuity rates, and consequently annuity rates are very high compared to where they have been in the past. So somebody looking at an annuity rate of maybe 30 to 1 would probably favour some of the alternatives that they've got under the pension freedoms there. And indeed, that's what we're seeing with some of the stuff that we've just published recently in terms of the Pension Freedom Index, where we're looking at the options that people are taking through our tools of annuity versus drawdown versus lump sum. And indeed, where we're looking at on that is something like a third of people favouring annuities at this point in time through that Pension Freedom Index and through the information that we're getting through on that. Compared to prior to the introduction of any of this, maybe 95% of people taking that default annuity option. Now, over the longer term, it could have a much more material impact. So looking out 30 years, at the moment, the buyers of government bonds in the UK particularly are the insurance companies buying them to back annuities, and the pension funds buying them to back their liabilities to pensioners. If we see a change over the longer term of how pensions are provided, then there could be some material changes in who actually owns those government bonds over the longer term. But that's a very long-term view of maybe 30 odd years out before we see any substantive changes in the nature of those investors.
Okay, so the other question that we had was that obviously we mentioned that eValue's a economic scenario generator model and how that differs from other models that are available in the market.
Basically, an economic scenario generator that we use starts from a model of the economy and aims to forecast forward from that. The other alternative that's in common use is a mean variance covariance model, an MVC model. An MVC model doesn't start from a model of the economy and build up asset returns from that. It starts from basically replaying historic returns with some assumptions about those returns in the future. Now, it's all about what model is fit for the purpose for which you're using it. And MVC models are very simple and have a lot of uses in many cases. but tend to fall down in terms of longer term forecasts, which is the primary purpose of what our economic scenario generator model is built to do, is to provide sensible long-term forecasts of the outcomes of investments in the hands of consumers.
Okay. If there are no more questions, I think we'll sort of wrap up at this stage. Thank you again for all those people who've attended. And as I said before, you'll be getting a copy of the slides, and we'd also very much appreciate your feedback. So thank you very much, and I look forward to talking to you all again sometime in August.